everybody, this is Rob Kientz, your host with the Freedom Report, and I'm recording this on Tuesday, October 14th, 2025. As we get into the middle of the month, we've had some very interesting things go on in the silver market, and that's what I'm going to be talking about today. I got lots of charts and things for you guys, so we're just going to jump right into it. There have been reports of a silver squeeze 2.0 in the silver market, and we're going to go through what's going on and the reports in the press. Now, before we do that, I wanted to note that last time we had that silver squeeze back in the 2020-2021 timeframe, prices got tamped at 30 here in the U.S. on the markets. A lot of the flow was going into ETFs. And I said, honestly, that's paper silver, and we wouldn't have a real squeeze until people actually bought the silver and took it off of the market. Because what happens when you buy silver in the ETFs, most of that is stored in the UK or the London market, underneath what the LBMA manages, or underneath what that London market manages. And it basically just stays in the warehouse and gets traded back and forth. But to actually have a silver squeeze where there's not enough available physical silver, you can't do that in a contract or a paper trade. You basically do that out of the physical markets. And that's exactly what happened. And I predicted this would be silver squeeze 2.0 several years ago. I said, when silver squeeze come back, it's going to be because you're having a physical squeeze. Now, I have documented on previous shows recently that there was over 200 billion investment into the SLV silver ETF in the last, I think, 6 months or so. And then in August, it blew out and there was a whole bunch. I mean, just a bunch of silver investment. So it always starts that way. It always starts with the generalist investors or even silver investors that have access to funds in some sort of, here in the US, like a trading account or a retirement account. Most likely it's like a Schwab account or E-Trade or something. And they want to take those funds and move them in to get silver price exposure. They're not necessarily trying to take delivery. And in fact, through a lot of these ETFs, you can't take delivery. Well, what we've got going on is now we're having a squeeze in the London market. And we've got a quote here from Robert Gottlieb in a Jerusalem Post article that says, "No free floating silver left." I'm going to walk down this article and another couple of articles, and then I'm going to go over the data so that you can see what's actually going on. It says here, quote, "For years, whispers of a coming silver squeeze have echoed through precious metal circles. Now it appears the moment has arrived and the consequences are reverberating from London to Tokyo. As Robert Gottlieb, an executive at JP Morgan Bullion Bank, bluntly put it, there is basically no free-floating silver left. That declaration, coming from one of the most powerful insiders, has electrified the metals market. Lease rates explode, short sellers panic. Silver lease rates, the interest paid to borrow physical silver for delivery, have rocketed by 20 to 30%, far outpacing those of platinum. This is a rare signal of scarcity in an otherwise abundant market. A recent J-Post analysis of the current silver squeeze explores how London's shortage is just a preview of what may come when the paper silver system begins to unravel." As a side note, I've had it on my channel, Twitter for sure, and on YouTube, how the TD Securities market analyst came onto mainstream media and said that silver squeeze 2.0 was starting and it would be a physical one. So this has already reached mainstream news and it's starting to reach press around the world. Going back to the article, quote, "Simultaneously, both gold and silver recently smashed through critical psychological levels, piercing the $4,000 and $50 thresholds, signaling powerful momentum, as detailed in J-Post's report on gold and silver key levels." I'm going to get back to how these technical and psychological levels work in the market. There's been criticism of me and other Western market analysts on various channels lately of continuing to follow technical trade and saying that has nothing to do with the market. And I'm going to prove to you that it does, that you have to follow technical and fundamentals. I do believe fundamentals will eventually overwhelm technicals. I've said that in my entire career and writing about gold and silver dating back now 16 years when I started writing for Seeking Alpha and got syndicated across numerous mainstream publications, including Yahoo Finance, NASDAQ, MarketWatch, and others when I was writing. And it does matter, but we'll get back into that in a moment. Going back to this article, borrowing silver now costs 12% if you can find it. On the paper side, and again, this article is acknowledging the paper side of the trade, the iShares Silver Trust, SLV, which I referenced at the beginning of the video, is now seeing borrow fees near 12% with no shares left to short. For those betting on downward price movement, the pain is intensifying. They're forced to pay steep borrowing fees while incurring losses as prices climb. These shorts are literally being squeezed in the paper market, which is going to lead to an explosion because the physical market is also being squeezed there's more demand for supply. Continuing on, this squeeze operates from both sides. Rising prices erode short positions, while lack of availability and soaring borrow costs tighten the noose. A related J-Post feature on ETF pressures and borrow costs shows how these dynamics are reshaping the market. Gottlieb's statement about no free-floating silver is no idle rhetoric. It reflects the reality that virtually all deliverable silver, that is physical, the metal could be transferred or leased, is tied up in ETFs, industrial contracts, and other long-term commitments. As I've said on my channel repeatedly over the last few years, this was happening and is going to happen. Little remains unencumbered, meaning free. One J-Post investigation into physical silver scarcity highlights how cross-border flows and deliveries are already being affected. And we're going to go to the next article from J-Post. This one is USA sends silver bars to London as historic squeeze hits. The U.S. has shipped silver bars to London as an historic market squeeze pushes prices above $50 an ounce. Physical shortages and soaring premiums signal unprecedented global silver stress. This is reported on October 12th, just a couple of days ago. The global silver market, according to the article, is facing an unprecedented crisis as a severe physical shortage in London forces U.S. silver bars to be flown across the Atlantic to stabilize supply. Benchmark silver prices have surged above $50 an ounce, marking only the second time in history that a precious metal has reached such levels, recalling the infamous 1980 Hunt Brothers squeeze. Liquidity crisis hits London, which, by the way, it hit London before, I guess about 6 or 8 months ago, maybe a year ago. I don't remember the exact timing, when there were reports that London didn't have enough physical silver. And I have been reporting the chart from the LBMA's website where the silver held had been flowing down and down and down. And on that chart, we didn't know how much was already committed to things like ETFs and other private contracts because not all of that's reported. But you could pull that chart about London inventories and ETFs and see that the free floating was shrinking by looking at the two charts. I did that probably 30 or 40 times within the last 2 to 3 years. Well, now it's hit. Now we're seeing what's happened as that's been drawn and more is flowed into ETFs. That gap between free floating silver and claimed silver in the London market is now reaching a crisis level. According to Bloomberg, mainstream U.S. financial media, the London silver market is suffering near total illiquidity. Traders short on physical silver are scrambling to secure metal, often paying extremely high borrowing costs to maintain their positions. There is no liquidity available currently. What we're seeing in silver is entirely unprecedented, said Anant Jatia, Chief Investment Officer at Greenland Investment Management. Now, multiple major investment management firms, TD Securities, Greenland Investment Management, and JP Morgan, who are involved in this trade, are reporting the same thing. So we pretty much can say that there is a worldwide global silver squeeze going on, that the last bastion of supplies may actually be in the United States, and we'll get to that in a moment. It says here on the article, London has been the global hub for precious metals trades for over a century, setting benchmark prices and circulating vaulted bars among a tight network of banks. Traditionally, secure trucks handled daily transfers of metal, but with the current shortage, cargo planes are now moving silver from New York to London, a transportation method normally reserved for gold. Why? Because it's expensive to do this, and therefore gold has higher prices, and therefore you can kind of do it. And when you're shipping gold, you're shipping millions and billions of dollars, whereas silver per ounce is a lot cheaper. So it's expensive to put a bunch of heavy silver on a plane when you're talking on a per ounce basis. It's going to raise the cost of those silver bars quite a bit. Quote, some traders have rushed to book slots on the cargo holds of transatlantic flights for bulky silver bars, Bloomberg reports. Drivers of the squeeze. The squeeze stems from a combination of structural shortages and surging demand. Is that industrial demand or monetary demand? I think this is now, we're in the era of monetary demand in silver, and that's what's pulling up the price of silver. Persistent investment demand amid Western debt concerns and fears of currency devaluation, just as the article says. Structural decline in London inventories. Available silver, remember ETF trade removes available silver off of the markets. Available silver has fallen from over 850 million ounces in 2019 to just 200 million ounces today, a 75% reduction in 6 years. A spike in Indian purchases during Golden Week, shifting demand from Hong Kong to London. This is normal as India has demanded a lot of silver, and they did that when India put some import restrictions on gold. People flipped to silver, but they use gold and silver in their love trade. So does China. This is the time of year it happens. That's one of the reasons you get cyclical uptick in prices in gold and silver, is because of that intense physical demand in those Indian and Asian markets, but we're also in a squeeze, so it's accelerating, and that's why silver has popped past its previous all-time non-inflation adjusted high of $50 an ounce. We haven't gotten to the inflation adjusted high, so I expect it to continue to march on as well. Potential U.S. tariffs on silver imports adding uncertainty to global supply is another reason. In the quote, the remaining free float of metal has dropped to just 200 million ounces, down 75% from 2019, Bloomberg notes. Even exchange-traded funds are suspending new inflows. Kotak Mahindra Asset Management cited a shortage of physical silver in the domestic market, with premiums sharply above international bookmarks. You're starting to see areas have higher premiums due to what? Local supply and demand characteristics. What have I been saying for years is going to happen to the precious metals markets? No longer will London and the COMEX and the US control prices, because when the physical squeezes come and when that demand surges, the markets are going to break apart into regional markets on premium pricing and on physical deliveries. We're seeing the US fly bars to London because different regions have different characteristics. No longer are we going to have spot prices and premiums, the actual price you buy, controlled by two major hubs in the world. That is changing as of now. And those price mechanisms are going to shift east to the BRICS nations, to China, India, and Dubai. The London Bullion Market Association, according to the article, has acknowledged tightness in the silver market and confirmed that it is closely monitoring the situation. Price dislocations reach historic levels. The squeeze has caused extreme dislocations in pricing and trading. London spot premiums are now up to $3 per ounce above New York futures. So that's why you're going to see the scalpers come in and play that trade, because if London's higher than the US, they're going to play that trade on the paper side, and it's going to exacerbate some of the issues with pricing that eventually is going to cause that pricing model that was congruent or together between London and New York start to split and to fade. And then again, these other regional markets are going to start taking precedence on the actual physical trade around the world. And so spot prices will no longer be determined just by the London and the COMEX. The spot and futures prices and how close they are together. I should say that. Overnight borrowing costs exceed 100% annualized, likely surpassing levels seen during the 1980 Hunt Brothers squeeze. Bid-ask spreads have widened from a normal few cents to over 20 cents per ounce as banks withdraw from quoting. We've had several banks stop quoting, and that has been in the news. Banks don't want to quote each other, so the quotes get extremely wide, said Robert Gottlieb, former JP Morgan trader. Why? Because of regional differences in supply and demand and the derivative markets and how they're pricing. That's why. All right, there's more on that article. We're going to move on. There's an article in Bloomberg. I'm not going to unlock the paid edition, but this was an early report. But the next Bloomberg article on Yahoo Finance is even better. So I just want to show you: silver traders rush bars to London as historic squeeze rocks market. So yes, we're shipping them over there from the US to the UK, and I just want to confirm that with a mainstream source. Here's a really good article on Yahoo Finance breaking this down. But it's going to show that the squeeze has some signs of easing. So there is some temporary liquidity and physical being provided to the market. But as the US drains their physical to London, what's going to happen is you're going to start to see silver squeeze come to the US. So this is temporary, the article I'm reading to you today, but I wanted to put out that there is a temporary little respite in some of these pressures, not completely, but this temporary respite or pause in some of these pressures, or slight reduction or mitigation of some of these pressures, is going to be exacerbated as the US runs out of silver supply, because we might be the last bastion of physical silver supply. And that's not saying much, because we ain't got a ton over here either. From Bloomberg, silver falls as London market squeeze shows some signs of easing. This is on October 14th, this morning at 8:27 a.m. It's about 2 hours earlier than I'm recording this video. The exact time I'm recording it is about 10:30 a.m. Central Time in the US on October 14th, Tuesday, 2025. Spot silver prices retreated after hitting an all-time high earlier Tuesday, as a historic squeeze in London began to show some signs of easing, although supply remains remarkably tight. Spot prices for silver fell 3.4% after hitting a record $53.55 an ounce in London earlier Tuesday. That's about $1 higher than the peak set in January 1980 on a now defunct contract overseen by the Chicago Board of Trade, Hunt Brothers, so on and so forth. Concerns about a lack of liquidity in London have sparked a worldwide hunt for silver, with benchmark prices soaring to near unprecedented levels over New York. That's promoting some traders to book cargo slots on transatlantic flights for silver bars, an expensive mode of transport typically reserved for gold, to profit off of higher prices in London. Again, another confirming source saying the same thing, that we're having some shortages in physical in London because of ETF demand, which I've been documenting over the last several months, how it's exploded and how this is capital rotation of other markets flowing into silver through these derivative contracts that are ETFs, and they're derivative because you can't get the physical silver unless you're an authorized participant in most cases. And like on the SOV and GLD, I think it's like 50,000 shares or something like that. So the average public does not have redemption rights. And on most ETPs and ETFs, you don't have redemption rights. Very few do you. And even if you go to the Sprott one, you have to have a lot in there, the PSLV to redeem, or else they're going to cash you out in cash. So when you go into these types of investments, they are derivatives because it's really hard to get the actual physical silver. Reading on, these silver bars will start arriving in coming weeks, multiple traders said, and the arbitrage trading has already substantially eroded the premium. The gap fell to about $1 an ounce on Tuesday, down from a spread as much as $3. So if you look at this chart, you can see the spread versus COMEX had widened on the chart dating back to about right here, and then it kind of plateaued here, and then it's rising up as the expectations in mid-October are that silver bars are coming. And this is just the arbitrage. It doesn't mean the physical silver trade is completely relieved, because if demand keeps rising, more bars have to be sourced. And once the U.S. market runs out of them, they're going to have to go wherever else in the market anybody wants to sell at higher prices. And if that's not enough, then you have to go to the mines. And the problem with the mines is the silver mines, primary silver mines, have not been expanding. They've been contracting, and it takes years to bring them online. I'm going to have a series of masterclass videos coming up on my channel talking about the mining sector, talking about wholesale retail markets here in the U.S. and the derivative trade and pricing, and a 3-part series. Stay tuned for that as we broadcast that. So I explain to you in detail how it all works and my experience in it. I'm going to have pictures of me doing various things. It's going to be a lot of fun. Stay tuned to the channel for that. But back to this. Last week, silver lease rates, which represent the annualized cost of borrowing metal in the London market, surged to more than 30% on a one-month basis on Friday. One-month borrowing costs were still at eye-watering highs seen on Tuesday at about 14%. What we're seeing is in something like silver is just a mismatch maybe with some of the paper contracts relative to the physical positioning. E.V. Hambro, BlackRock thematic and sector investor global head told Bloomberg TV on Tuesday. Silver lease rates ease slightly, but remain elevated. You can see the history of them. They're elevated quite a bit. They're still over that 10% mark. A jump in demand from India in recent weeks has drawn down the supply of available bars to trade in London. Again, the love trade, the ceremonial trade, that type of thing going on in India and in China at this point in the year is predictably drawing down physical inventories. And because they were thin to begin with, it's caused this spike in lease rates. And again, more is coming from investors in ETF trade that want investment demand, and that's on top of that. So as that love trade eases as we near the end of the year, I expect a little bit of relief in the physical silver market, but investment demand is going to continue to go. So it's going to be very short-term relief if we get any to end the year. Back on to the article. That followed a rush to ship silver to New York earlier this year as concern that the metal could be hit with U.S. tariffs sparked large dislocations between the two trading hubs. While precious metals were officially exempt from levies in April, traders remain on edge ahead of the conclusion of the U.S. administration's so-called Section 232 probe into critical minerals, which includes silver as well as platinum and palladium. The investigation has revived fears that metals could be swept up in new tariffs, exacerbating market tightness. Now, I want to tell you something, that the U.S. government has committed to $4 billion, that's right, $4 billion in commodities purchases and development of the commodity sector here in America recently. There's, I think, about 1.5 billion is buying supplies of rare earths, scandium, and some other critical minerals, and silver being one of those, to shore up our domestic supplies for our industry. And 2.5 billion is going into development of new supply chain. That's going to be mine output and manufacturing. So the U.S. is now committed 2.5 billion, the government, into manufacturing of critical minerals, of which silver is one of them. And so we're going to start developing our rare earth, silver, and other critical mineral mines going forward. The U.S. is returning to production, but again, it takes years to develop that. So in the meantime, they're just trying to buy it off of the market. So the U.S. government's actually part of why we're seeing a physical silver squeeze. That was reported in the media a few days ago. At the same time, according to the article, Goldman Sachs Group analysts warned of the potential for price correction of relatively illiquid silver market that's 9 times smaller than gold's. Without a central bank bid to anchor silver prices, even temporary pullback in investment flows could trigger a disproportionate correction, as it would also unwind the London tightness that drove most of the recent rally. The four main precious metals have surged between 52 and 82% this year. That's gold, silver, platinum, and palladium. And a rally that's dominated commodity markets. Gold's advance has been underpinned by central bank buying, rising holdings in exchange-traded funds, and rate cuts by the U.S. Federal Reserve. Demand for havens has also been abided by recurrent U.S.-China trade tensions, threats to the Fed's independence, and a U.S. government shutdown, so on and so forth. So we're going to look at the silver borrowing rate. That's iShares Silver Trust. That's the rate at which you can borrow silver. It's like a lease rate. And when it goes higher, it indicates tightness. Why? Because rates are going to go up when there's not as much for the borrowing. Why would they borrow it? Because they want to use the physical silver now for something, jewelry or whatever, satisfy derivative contracts, coins and bars, whatever the case may be. And they're going to return it later. And for that privilege, you have a borrowing rate, just like if you're borrowing cash and you got to pay it back to your bank to pay off an auto loan, a credit card, or something like that. Same thing happens in the gold and silver markets. And when those rates get elevated on risk, it's a risk-based rate. The rate is based on anticipated future risk of getting your physical back versus having to just get cash, if they can even provide the cash, because if the lease rates are really high, it grows the principal and interest balance over time. Same thing with getting high mortgage rates. The higher the mortgage rate that you get, the worse it can be in terms of the total amount that you're paying over time. So when these borrow rates go higher, it means that the silver is costing the borrower more over time to pay back, whether it be physical or there's a cash settlement position. We can see that red bar here on the end as of October 13th. That red bar is showing that we've eased a bit from 14% down to about the 11.5% mark. So there's been some easing, but you can see the normal is usually around 2%. Sometimes it spikes. You saw it spike a little bit up to the 6% mark, but it's usually somewhere between 2 to 4% in gold and silver in a normal market with physical available, but it's spiked up to 14% with the candle going to over 15%. And then it eased and came down only basically in the recent couple of days of trading this week. But it is still elevated, and that's something to watch because it does indicate the tightness in the London market, because the SLV is that ETF that operates in that market. Again, a confirmation of what's going on in London. We're going to go over to the American market and see what's going on in the silver contract for December, why that's the biggest remaining contract of the year. And so that's where we're going to get the most intel on what's going on. And as you can see, as you go over here, this is a commitment of traders report, and I'm going to focus on the pretty colors. If you look at the top rung, it's broken into three pieces. This is what they call the aggregated report. You've got commercials consisting of producer, merchant, processor, user, and those aren't split. They are in the other one, which I'll get to in a moment. That's just commercials. That's the main buyers and sellers, the users and the producers, if you will. The non-commercials are speculators, so like Wall Street, financial houses, that type of thing. That's in green on this top chart. And then the small speculators are in purple or blue, if you will. And the small speculators, non-commercials remain long, and the commercials, producer, merchants, and the banks remain short. Why would the producers remain short? Well, the producers remain short because they produce it, and they're taking a short position in that derivative market to protect against downside price risk. It's like insurance. And I had a Series 3 commodities license years and years ago in the United States. I don't any longer have it, but I have professional training, and I worked in the Forex and the commodities markets for a period of time to learn them for a major broker dealer here in the United States. And I learned how this works. And essentially, the shorts are not completely for hedging actual physical. There's a lot of gambling, and even the bullion banks, which are part of the commercials, gamble in the market. So usually this red would be an indication of physical supply and demand, and how you may take a short as insurance or a long as insurance if you're a merchant. Let's say you're buying silver, and by the way, yeah, so you're buying silver, and essentially you're buying it, and if the price rises, you want to have that long position so you can take profits in the market as a form of insurance. That's basically how it works. But a lot of it really is gambling and speculative, because these positions that are traded on a daily basis outweigh the actual physical trade by hundreds of times most of the time. In fact, usually it's 99.99% or just derivative trades that actually determines futures prices, which affects spot prices, because in the London market, it's the same thing. There is more demand than physical metal. And so these are derivative prices. The prices that you pay at your coin shop and the prices that Samsung pays And the prices that these mines can sell at is largely a derivative function of the physical market. The derivative market's bigger than the physical market. We're going to break it down into the 4 categories. The red here is the commercials. That's the producer, merchant, users. The green is the swap dealers, which are the bullion banks. The non-commercial managed money is basically the financial sector for all intents and purposes. And other reportables are large family offices and other individuals that are big enough to trade on that market, but aren't part of like a big financial house. Okay, and as you can see, the 2 longs are the blue and the yellow, the managed money, the financial side, and the other reportables, the other ones in it for financial speculation. They remain above this 0 line here. So you can see 0. They remain above. And then below are the commercials, the producer merchants, which makes sense because they have downside price risk. They're bringing it to market and they're always worried about the price falling. So the producers are always going to be short. The merchants would want to be long to predict against upside price risk, but when you smush them together, the producers win and it's net short. But look at the biggest short, the green line is the commercials, the bullion banks or the swap dealers. Those are the 4 largest banks plus the other banks that trade that market. They're constantly shorting for that price. And depending upon the supply and demand at an instant on the trader screen in these commodities markets, gold, silver, oil, all of them, you know, one big large sell order can bring that futures price down. One large buy order can elevate that because that's the actual market. It's bid ask at the time, the millisecond that you're quoting a price to do a trade. And so that's how that works. And so basically the short is basically the producers, the merchants, and the swap dealers. The swap dealers, the bullion banks, and I've showed this on the Office of the Comptroller of the Currency report many times. And when I used to put out the other charts that I got through Gold Charts R Us, you could see that the bullion banks are consistently shorting that market and taking money. That's just a gambling or a speculative trade. But what about physical? What's happening to the physical? Well, we had a report from my friend Jerry Huang, who is on the mining side and does a lot of mining stock investment, also the CFO of Impact Silver, and also runs a mining stock investment service as a principal, is reporting the Perth Mint. We're experiencing technical difficulties with our system, working to fix the issue as soon as possible. And due to current market conditions, we're experiencing a high volume of customers, which may cause delays in response times. This was reported yesterday. And so I went to their website and it says the queue for today's in-store services, when you go physically, the Perth Mint in Australia is now closed. And this is closing. And it says gold and silver sales continue as usual. Please note high demand is causing delays. So they've reopened the market. I can go in here and order a coin or bar if I want. I was kind of playing around with that. But there is such demand at Perth Mint that there were some physical supply shortages. And we've also seen physical supply shortages in other areas as well in the global market. So what that essentially means is there is not enough for what people want in silver especially, but some in gold as well. And so I think we're starting to see the beginnings of the actual physical squeeze for the reasons that I noted. But you still have to watch the prices, lease rates, premiums, things like that in the derivative markets to know where the price is going to go, because they still control what the price is, regardless of what happens to physical. The derivative markets, the overwhelming amount of contracts on that determine the price. Now that can be moved by physical trade for sure, because people will then begin to play the physical trade deficiencies on those markets. And eventually I think the derivative trade pricing will be broken. We'll have regional markets in which physical plays a larger role according to regional supply demand characteristics. That hasn't quite happened yet, but we're seeing it start to happen. And that's the era we're going into, where this sort of squeeze by London and the United States, or UK and United States, on gold and silver prices for the world are starting to break. And by the way, I think that will happen on other commodities trends as well, especially gold, which is going to go through a deflationary period due to decreasing world demand. We'll cover that in another report sometime in the future. That is your gold and silver report, but really it's about what's happening to silver. Silver Squeeze 2.0 is here. I predicted it 5 years ago. It's exactly what's happening, and it's happening through physical trade. It started around the world with some of these late fall festivals. We're also seeing large buys by big buyers of the physical across the world, not just Perth Mint, but it's been reported in other places as well. ABC in Australia. So Australia is having a big run. Some other countries are having big runs. We haven't seen quite the shortages here in the United States in the physical yet, but lines are queuing up. We're starting to see an increase in orders. But in the US, it always starts with a derivative. It starts with ETFs. And that's actually what bankrupted the London silver, is people going into SLV and other ETFs. And eventually, when they figure out that London's running short of physical, the people in the United States are investing in those ETFs are going to flip to physical trade because they're going to know that they're not going to be able to buy more shares. And in fact, you could even have at some point in time the SLV, the main silver ETF, or maybe some others halt trading temporarily until they can get the silver. That was essentially what they thought was going to happen during the original silver squeeze several years ago. Well, because inventories are even thinner now, available inventories, and we got those quotes from Robert Gottlieb and those three banks, TD Securities, Greenland, and JP Morgan now reporting the same thing. Because those physical shortages, now you're going to start to see the actual squeeze. That's one of the reasons silver popped 50. But again, it's not its inflation adjusted all-time high. It's going to keep going. And again, lastly, what's going to happen is you're going to start to see the breaking up into regional markets and the derivative complex pricing scheme that's been over these markets for the longest time start to break apart. And you're going to start to see very high premiums on certain products. And that's going to reflect, the higher premiums are reflecting the actual physical demand versus the spot and futures derivative markets. I'll have more on that in a masterclass coming up in the coming weeks. But that is it for now for the Freedom Report. Silver Squeeze 2.0 is fully in play, and I think it's going to come to gold soon as well, although that will take a little bit longer. It may be next year, but we're going to keep an eye on it. Stay tuned to this channel for more from Rob Kientz at the Freedom Report.